So that brings us to our question of the day. Given the numbers we've just seen, is 75 basis points enough? We are seeing swaps taking us in that direction. Let's get an answer to that question. Tiffany Wilding, PIMCO's chief US economist, joining us now for analysis. Tiffany, 75 enough?
Yeah, I mean, I think today's report certainly made 75 the base case. I think it's possible that Federal Reserve officials could start to talk about this 100 basis point rate hike, although I would suggest probably 75 is still the most likely here. Now what I will think will happen is the summary of economic projections that the Fed puts out in September. They're not only going to do 75, but they're going to also sort of show or guide the markets through that there's more to come in the back half of this year. They need to do more. I think at a minimum, you're going to see the median jump up to 3.8, which was where it was to 2023. So they're going to basically front load or pull forward rate hikes even more than they already have.
Well, so Tiffany, to that point, is this changing the pace of hikes or the ultimate destination?
Yeah, so I think that's a really good question. I think we would argue, at least right now, that it'll probably change the pace of rate hikes. And it's certainly possible that we could see a hike or two more that they pencil in for 2023. So maybe a little bit higher. But of course, the Federal Reserve wants to continue to assess and see data. And I do think the one thing that probably will give them pause is that we are getting very inconsistent signals depending on what data you look at. So if you look at a broader range of labor market indicators, and obviously the things in the GDP report or spending indicators, they do suggest that the economy is slowing. So it's a little bit puzzling that none of that is showing up in the labor market report, at least in the establishment survey. But Federal Reserve officials will be, I think, cautious at least that some of that could show up, in the months and quarters ahead.
So Tiffany, how high do you think we ultimately end up going with the Fed, and how long do we stay there?
Yeah, I mean, I think that is really the key question, obviously, for markets. And it's one that's obviously highly uncertain, and it's something that the Federal Reserve is going to have to continue to assess as they hike. And what makes this more difficult is that monetary policy works through long and variable lags. So, the hiking that they've done so far, that, isn't fully going to be reflected in economic outcomes, for at least some time to come. We're starting to see, the housing market and some other interest rate sensitive sectors of the economy like autos, et cetera, start to slow down. But we really haven't felt the brunt of that. So the Federal Reserve is probably going to get to a place, they've said moderately restrictive, where they think they need to be, see how much the economy is slowing down, and then assess if they need to move higher, kind of stay there or move lower. So I think this is going to be, kind of like a guess and check. It's difficult monetary policy in practice, certainly more than an art than a science. So now I think this is very uncertain. But I do think, though, again, the end of the year, having them forecast they get to kind of a 3.8 level, to us, I think makes sense.
Yeah, to your point, Tiffany, on the lag, clearly, if they're trying to get demand down in the labor market, we are not seeing evidence of that yet. But it begs the question, what they want to see is the number of available jobs in the economy coming down and inflation pressures, therefore, coming down as well. What level of unemployment do you ultimately think that will take? How far above it is 3.5%?
Yeah, I mean, so there's this whole discussion right now about, because the number of job openings is so elevated, and we just haven't had people, been able to fill them. There are frictions in the labor market as a result of the pandemic, people moving out of city centers. You have this migration happening, people moving to different sectors, reallocation. All of this is creating friction in the labor market. And that's resulted in higher openings relative to a given unemployment rate. So the question that Federal Reserve officials are trying to understand, is that can we just bring down the level of openings for jobs without really getting, without having people, laid off or getting fired? I think that is going, history would suggest that's going to be difficult. You do tend to get labor market weakening and the unemployment rate ticking up when you have growth slowing. So not to mention if there's a recession, right? So, ultimately, I think the unemployment rate does tick up over the next year or so. And certainly it'll be a question on how much, and we'll have to continue to watch and monitor the data to get a better sense of that.
Upside surprise today. What happens, Tiffany, if we get an upside surprise next week on CPI? The number's expected to go 9.1 to 8.7. If that number comes in hot, how does that change the calculation?
Yeah, I mean, I think that it ultimately it confirms, that inflationary pressures, it's just one more data point confirming that inflationary pressures are broadening out. Obviously we saw that in the wages data that came out this morning. You're seeing that in a broad array of wage indicators that are being released. So, I think that's ultimately concerning. Obviously the details of any given report will matter, but what, is becoming more clear, I think, in the economic data is that although headline inflation could start to tick down because we've had some easing in energy and food prices, the kind of more core measures, they do look like they're going to be more, more sticky at elevated levels. So I think that again, will continue to be concerning for the Fed, although they are going to get some relief probably on the headline measure. Now, and just in terms of how this relates to a recession, I think the other important thing here is that although today's data confirm the U.S. economy is not in recession, it also confirmed that the Federal Reserve needs to do more to tighten financial conditions. So I don't think that it really changed the recession probabilities at kind of a 12 to 18-month time horizon, because the Fed just has to probably do more. But just engineering below target inflation might not be enough, right? You might actually have to get some contraction to bring inflation down.
Well, finally, Tiffany, this jobs report culminates a week packed with Fed speak in which they push back pretty aggressively on that whole pivot narrative. Are we seeing the return of guidance just after guidance was supposed to have died?
Yeah, well, I think ultimately, although Fed Chair Powell tried to get rid of guidance at the press conference at the July meeting, ultimately he provided guidance by pointing to the summary of economic projections. So he didn't actually, fully get rid of guidance. So I think that, overall Fed officials, they do need to try to, stop providing more concrete guidance. They have to start focusing on the data, and kind of give markets a sense for how they're going to react to some of the scenarios around their baseline outlook. So then the market can price in what it thinks the Fed is going to do on the Fed funds rate without them giving guidance. I think that's the best outcome. It looks like the Fed is sort of slowly moving in that direction, but we probably have more to do in terms of just fully getting rid of this, forward guidance.